to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, we'll have another wonderful interview, this time with Phillip Newman, founding partner and managing director of Metals Focus. Phillip reminds us that price corrections should be viewed as healthy consolidation periods rather than the end of a bull market, and tells us how the underlying price drivers remain fully intact. Phillip also expects strong investment demand to potentially offset any possible slowdown we may see on the industrial demand side of silver that may result due to these recent higher prices. And Mr. Newman also shares some of the key drivers for these higher metals prices, along with his firm's analysis of the developing shortage that has been materializing in silver specifically. So be sure to stick around for another wonderful Money Metals interview with this week's guest, Phillip Newman of Metals Focused, coming up after this week's market update. And as a reminder, please download, like, rate, and subscribe to this podcast wherever you consume this content. Buy the dips in gold. That's the recommendation of UBS analysts after the recent correction in the gold price. After peaking near $4,400 an ounce, gold was hammered lower, falling to below $4,000. Since then, the price seems to have consolidated around $4,000, but volatility continues to dominate the market with significant daily price swings. It's important to put the recent sell-off in perspective, however. Even with the recent dip, gold is still up over 50% on the year and has essentially doubled since the beginning of 2024. UBS analysts said the pullback is temporary and they still like gold in the $4,200 an ounce range. In a recent note, UBS analysts said, quote, "The much anticipated correction has taken a breather," noting that they don't see any fundamental reason for the downturn. UBS Global Wealth Management strategist Sagar Khandelwal said he sees an upside of $4,700 in the first quarter of next year due to falling real interest rates, a weaker dollar, rising government debt, and continued geopolitical uncertainty. Khandelwal said with the Fed apparently committed to looser monetary policy, real interest rates could flip negative. UBS emphasized that underlying demand remains strong, citing the World Gold Council's third quarter demand data. They say it confirmed very strong and accelerated buying by both central banks and individual investors. Gold demand grew by 3% year-on-year in Q3, hitting 1,313 tons, the highest quarterly level in history. Central banks alone have bought 634 tons of gold so far this year. UBS noted that while this is slower than last year's pace, it's still on track to reach 900 to 950 tons. Meanwhile, ETFs reported inflows of 222 tons of gold, while barn coin demand surged to over 300 tons in Q3. And despite higher prices, jewelry demand was also not as weak as feared. UBS analysts aren't the only mainstream voices recommending more gold. In a seismic shift in investment strategy that we've already been telling you about, Morgan Stanley CIO Michael Wilson recently recommended ditching the traditional 60-40 portfolio for a 60-20-20 ratio that allocates 20% to gold. Charts and Parts Substack argued that this could lead the way to a broader institutional shift, noting that nobody likes to go first. Not in markets, not in startups, not in fashion. But once the ice breaks, the floodgates can open. Meanwhile, silver has been on a wild roller coaster ride. The question now, is the recent sell-off a temporary correction, or have we reached the end of the rally? While the supply displacement that pushed silver to a new record high has moderated somewhat, the underlying dynamics that have been driving both gold and silver higher over the last 2 years remain in place. Silver gained nearly 40% in 2 months. This is the definition of overbought, and a correction was inevitable. And correct it did. And charting a new record high of $54.48 in mid-October, silver suffered the largest single-day sell-off in years just 11 days later, plunging 16% to a low of $45.57 on October 28th. Since then, silver seems to have found support in the $48 range. It's important to remember that even with the sharp correction, silver is still up over 65% this year and ranks among the best-performing assets. Silver's sell-off corresponded with a similar correction in the gold market. Metals Focus called the correction, quote, long overdue. Our interview guest this week, Phillip Newman, will share more of Metals Focus's analysis coming up here in just a moment. If anything, silver's resilience in the wake of its $7 to $8 sell-off from its highs is reason for optimism. The longer that silver moves sideways in the $45 to $50 range, the more likely it will not be heading lower. And it could just be recharging before the new rally back above $50 and beyond. Of course, time will tell, but remember, these are volatile markets, and it's never prudent to go all in on any investment theme, regardless of its merits. Lastly here, before we get to this week's interview, let's take a look at the weekly market action and check in on where we stand currently with a few hours left in the trading week. Gold is now up about $10 or a slight 0.2% to come in at $4,026 an ounce. Silver is down slightly, off 0.4% to trade at $48.72. Platinum is off 1.1% to check in at $1,564. And finally, palladium is down 2.9% and comes in at $1,421 an ounce as of this Friday morning recording. Well now, without further delay, let's get right to our exclusive interview with a metals market insider.
Greetings, I'm Mike Maharrey, and I'm joined today by Phillip Newman. Phillip is a founding partner of Metals Focus and the organization's managing director in London. And always a pleasure to have you on the show, Phillip. How are you doing today?
Not too bad at all, Mike, and thanks for having me on again.
Yeah, always a pleasure. And as you referenced, we have had you on the show before, but I don't want to assume that people know who you are or what Metals Focus does. So before we dig into the nuts and bolts, I would love for you just to kind of give an overview of what Metals Focus does in the work that you guys do.
Absolutely. So I'm one of three founding partners in Metals Focus. We started in 2013. We're now gone through over 30 staff that we have in 8 markets. And what we do is we focus exclusively on precious metals research and market intelligence. We don't trade the market whatsoever. And the reason we've got so many people around the world is that we spend a lot of our time on the road meeting companies across the supply chains, many of which are privately owned, trying to uncover really what's going on in the market. We bring that back. That goes into our historic and forecast supply-demand data sets in our cost models, our mine cost models, for example. And so you'll find that really in a range of reports that we bring out. Most recently, just about 2-3 weeks ago, at the LBMA conference in Kyoto in Japan, we launched our latest investment focus. So that's around and in the market. If you'd like to get a copy, get in touch with myself or Mike, and we'll happily put that through to you. So yeah, that's the kind of thing that we do globally.
Yeah, absolutely. Your guys, the work that you do is invaluable for the work that I do because folks like me rely on that data, and you guys do a fantastic job of both gathering it and communicating it as well. Always enjoy getting your reports and stuff and use them quite often in my own writing. So appreciate all of that. So with all of that in mind, let's talk a little bit about what's going on in the gold and silver markets. Let's start with gold. Both gold and silver have had a pretty healthy correction over the last several weeks. We seem to have kind of consolidated around $4,000 an ounce, it feels like. But I'm curious as kind of how you're looking at this in terms of the data that you're seeing and the supply and demand data. Do you think that this is is it the beginning of the end of the bull market, or is this just a healthy correction, and is there still more upside that we can possibly anticipate?
I think from our perspective at Metals Focus, it's definitely the second of those two. I think the run-up in prices at times has almost felt like a straight line, especially even as recently as September. You look at the gains we saw for gold and silver, and they were pretty eye-watering. And so I think it's quite healthy for the market when it does pause for breath, when there is a correction, a period of consolidation, as you say. I think that's very healthy. And I think it's just quite remarkable, the fact that you're talking about that, gold has settled around $4,000. And to consider, I don't know, a price north of even 3,900 as a floor is really quite remarkable. Or for silver, over $47, equally so. And I think it's important, despite that correction, that bout of relative weakness, the markets have held, those prices have held firm, at least for now. And again, I think that's remarkably, is a very positive indicator. From our perspective, when we look at the drivers for both metals this year, by and large, those drivers remain intact. We don't see them going anywhere. And so we think those positive price drivers will very much continue into next year and, from our perspective, push prices higher.
What are some of those price drivers that you're seeing that are kind of fundamental? And I think that's a really important key. I tell folks all the time, you don't want to get too caught up in the emotion of the volatility that we can often see with metals. It's important to look at those kind of fundamentals. So what are maybe 2 or 3 things that you see that are really underpinning support for both of the metals right now?
Sure. Well, I think one of the common threads running through some of these drivers is the impact on the dollar. So we look at the state of US debt. Is that how serviceable is that? And that certainly has put pressure on the dollar. We had this general de-dollarization move as well. I think it sort of gathered momentum back on April 2nd when you had Liberation Day. I think that really rattled a lot of the markets. And although there's been gradually some pushback on those tariffs, and of course we've got the ongoing court case now with the Supreme Court, so we'll see how that plays out. But I think that really rattled a lot of institutional investors. And I think probably one of the other things in terms from a dollar standpoint, of course, is the independence of the Fed. Even though there's been pushback against the firing of Governor Cook, the fact that, Powell's term comes to an end, I think it's around April, May next year. We're looking to see who is going to be put forward, and will they really push forward with the independence of the Fed? I think that is an incredible question mark. And I don't think we can underestimate the impact that can have on the dollar if the markets think that independence is being undermined. So I think those are some of the things we look at. You've got the health or relative health of the stock market, maybe some overvaluation there, investors looking to diversify. And then you've got the geopolitical backdrop. Now that, I think, is much more feeding into gold than silver. But you do get those spillovers between the two as well. So I think those are some of the factors that we are looking at in terms of really pushing prices higher. And that's why I say that I think a lot of these drivers by no means are sort of short-term by any stretch. And as I said, I think it will certainly spill over or carry over into next year.
Yeah, I agree with you completely. And those are some of the main things that I've been really watching as well, especially the Fed. I think it's I wouldn't say it's certain, but I think it's highly likely that you're going to end up with a Fed chair that is much more amenable to easy money, because that seems to be, the will of Trump. And I would argue that we're already in a pretty loose monetary situation. So that's going to be really interesting to see how that monetary policy plays out and how it impacts inflation and all of those things. I want to talk a little bit about the silver market because we saw a really interesting phenomenon with the movement of physical metal. We had kind of a shortage or a squeeze in London. We had too much metal in New York. That seems to have settled out as far as I can tell. But I would really like for somebody like you who has kind of watched this closely to explain exactly what happened with the metal in London.
Yeah. Well, I mean, you've got, there's plenty of metal in London as well. It's just a question of how much is available to the market because, the vast majority of that silver is allocated to ETFs. And I think at the end of September, we got down to about 13 or 14%, which was not allocated to ETFs. That's an incredibly low number. It's never been anywhere remotely close to that figure. And then at the same time, you've also got very strong, again, I'm going back into September, incredibly strong Indian silver demand, even though the Indian price has been at a record high long before we saw that in dollar terms. Investors there, retail investors, tend to be naturally bullish, and they were really buying quite hard into the market. And so India was just pulling metal from all sorts of locations, including London. So that was adding to that tightness. What was the specific event that caused lease rates to surge? Honestly, we don't know, but I think it's a case of almost like the straw that broke the camel's back. I don't think it required much to really see lease rates pick up, to see market participants, maybe starting to pull metal back from the market, worried about liquidity. And so I think it became a little bit sort of self-fulfilling. We saw short-term rates spike to about 200%. I don't know, if I'm honest with you, Mike, if any trades were done at those levels, but they were certainly done at these sort of eye-watering points that we do know. And so that really started to encourage metal to come from the CME into London. I think the other point to add there, of course, is, we've had, in terms of the volumes in the CME, there was a reticence by, I guess, risk managers at some financial institutions to release or to relocate some of that to London, because we've had two black swan events in the matter of a few years. You look at when you had the cessation of air transport in COVID, and now we look at what's gone in the beginning of this year with the EFP surging as well. And so if you're faced with that, plus there's still some tariff uncertainty, so you're faced with all of that, and so it makes absolute sense to hold on to silver in the CME, perhaps more than you would otherwise. And so, if we look at the totality of identifiable silver stocks, they are high. It's just they weren't in the right place at the right time, to be lent to the market.
Yeah. And I think I'm correct in understanding too that there was a big movement of metal to the CME into New York, like in April, May, because of the worry about tariffs, and that kind of added to it too, right? We had kind of a imbalance to start with that was kind of exacerbated by the sudden pickup in demand in London. Is that kind of a fair assessment?
Yeah, you had metal coming from London, other parts of Europe. We know other places that were air freighting across the continent into the US. And you also had silver loco US or loco North America also being put on the exchange as well. But you're absolutely right. Some of that coming out of London, again, added to that tightness at a time when you had ETF demand rising as well. So all of these, it was like a perfect storm, really. But hence why, again, lease rates spiked to those levels that we've never seen before. And now that's encouraged metal to come into London, mostly by air freight, because do you want to put it on the water with lease rates where they were? I don't think so. And you need it in London pretty quickly as well. So that's certainly been something that's going on the past few weeks.
Yeah, it's really interesting to think about the logistics involved in moving silver, because it's much bulkier than gold. And it's interesting, we actually sent Money Metals, we sent a pallet of 1,000 ounce silver bars to India. So that kind of tells you just how much the metal was moving and what the demand was in India at that point. I'm curious, so, we know that there have been structural market deficits for 4 straight years. So we're having a situation where demand is outstripping supply. Do you think that this was kind of indicative of maybe a little bit of that shortage more fundamentally in the market, or was it really just a matter of metal being kind of displaced? How do you see that?
No, I think you make a really good point there. The deficits that we've had, have been really eye-watering. They started in 2021. Before that, you'd had a mixture of surpluses and deficits, but 2021 was when we saw the really first big one. It was around, by basis our numbers, about 89 million ounces. Then it ramped up. It went through 200 million ounces. And so what you've seen now, but including our estimates for this year, you've had cumulative or combined deficits of almost 800 million ounces. Now, some of that has come from identifiable locations. A lot of it has come from sort of off exchange. And so that, I think you're absolutely right, that has certainly added to that general tightness, which was then exacerbated by the moves or the metal coming into the CME as well.
Do you see a fall off in industrial demand for silver with the price being so high? I've heard some analysts kind of talking about that this may kind of slow down the demand a little bit, at least on the industrial side. And is there enough investment demand to kind of counterbalance that in your view?
Well, I think we are looking at some of that to certainly slow down. I think that when you've got a price of around $50, a volatile market, risks of higher prices as well, there are some elements or some areas of the industrial market where there is going to be pushback. I think that is to be expected. If you can reduce the amount of silver that you're using, but you don't have the trade-off in terms of the utility of silver that you're getting in terms of a particular application, then yes, I think you will see that. Will that be offset by what we're seeing in investment? I think before we get to that, staying with the industrial, there are areas that are still growing. We think about the AI and the need for data centers, for example. That's quite an exciting one. And it's not just about the amount of silver that's used in the data center. It's just the opportunities that the AI technology gives other areas. So I think there's like a second order benefit, and some of which we don't know about yet, because there's almost like limitless possibilities with AI. So I think that's really quite exciting. And then you look on the automotive side, the growth in EVs, electric vehicles, and that growth has slowed, but it is still, you are still seeing market share gains by EV. And an electric vehicle uses more silver than, say, a hybrid. A hybrid used more silver than an ICE vehicle. So there are some positives out there. In terms of, will that relative weakness be sort of mopped up or offset by bar and coin? I think the jury is really out on that. The weakness that we've seen, at least until quite recently, in the US retail market has really been quite something to watch. So that is something we're keeping an eye on. I think for next year, you could see coin and bar demand pick up a little bit. It's possible. But the fact now that we're in an environment, and we've been this in a way since, I think it's late 23 almost, so that's 2 years of quite decent levels of liquidations by retail investors. So will that carry on? Will that dry up? I think the volumes that have come out are really a fraction of what's been bought in the US. That's certainly something we're really mindful about.
Yeah. Speaking of the U.S., I was looking at the World Gold Council's third quarter demand report, and this really struck me. And I wrote this. I said the only region with a decline in gold bar and coin demand in the third quarter was the U.S., coming in at just 7 tons. It was the lowest quarterly total since 2017, 2019, during that trough. So what's going on with physical demand? It's wild to me. We've had this huge run up in prices, and yet we've seen this retail investment demand kind of on the sidelines. Now it may be coming off now as we've gotten into September and October. How are you seeing this, and kind of how would you explain? I don't know that you can explain behavior, but it's just interesting. I wonder if you have any thoughts on that.
Sure. So I think the first thing to point out, whether it's with gold or silver or platinum, that the figures we report for the likes of the US is on a net basis. So what we try and do, and it's an imprecise science, it's really difficult to do, but we try to get an idea of gross purchases by retail investors and gross selling back by retail investors, and we combine those to give us the net figure that you're talking about. In other words, the gross buying by retail investors in the US is certainly higher than the figure you're referring to. Again, that's a really, I think, an important point to make. But to my earlier point, I think it really started around Thanksgiving 23, when we started to have liquidations emerge. And that really ratcheted up for both metals. And I think there's a few reasons for that, Mike. I think one of the first ones is, it's a while, I guess we should be thankful of this. It's a while since we've had a real crisis or an economic crisis in the US. I think it was about March 23 when you had the collapse of those two regional banks. Mm-hmm. And that really galvanized buying. And in fact, 23 would have been much weaker if you didn't have that. So that really, I guess, hid some of the weakness that was already starting to emerge. You got the traditional one of high prices, encouraging liquidations. I think another factor, which is really important for the States specifically, a lot of retail investors, they tend to be Republican leaning, if I can say that. Uh-huh. And so with Trump's victory in the White House, not only that, but he won all branches of the government. He had a majority on the Supreme Court as well. I think for a lot of investors, that took away the urgency to buy gold or silver. And for some, it encouraged them to liquidate as well. So I think those are some of the factors that we see really playing out in the marketplace.
Yeah, I think that you make a couple of really good points, and I didn't realize that those were net figures. So that's very helpful for me, and it makes sense because just anecdotally, I know from our company, we've seen a lot of selling, a lot of liquidation, a lot of profit taking, and understandable. When you have such a quick surge in prices, I think people get a little bit antsy when it gets too high, and they're like, okay, I'm gonna book these profits so I don't lose out. So that's fair, but I think you make a really good point too about the psychology, kind of the political psychology that you have going on with a lot of folks just being generally more optimistic about the economy because we have a Republican in office. Just between you and me, I'm not sure that that's necessarily justified, but it is what it is. So that's a very good point. Well, I want to get you out of here. Before I do, I definitely want to let people know where they can find all of the mini reports and all of the great work that you guys are doing over at Metals Focus.
Sure. So it's quite simple. Our domain is metalsfocus.com. So, please feel free to reach out to us. Just one thing, if I can mention while I've got you, Mike, which I think would interest a lot of your listeners as well, is that next Thursday, so November 13, we are taking part in a Silver Institute dinner and in New York, where we're presenting our latest findings on 2025, sort of an interim view, if you could call it that, before we publish the final data set in World Silver Survey 2026 next April. And if there'll be a presentation for that. If people want to get hold of a copy of that presentation, the Silver Institute will be making that available on their website on the day of the launch. And, we'll be talking about some of the things you've mentioned here about the liquidity crunch, about the impact of high prices on industrial demand, all the things you expect us to talk about. So that could be interesting for some of your listeners.
Yeah, definitely. I'll be looking forward to checking that out for sure. And do want to really just encourage folks to avail yourself of the work that they're doing, because I don't think there's any place better that you can find this kind of data and the kind of the granular supply and demand stuff that the folks over at Metals Focus dig up. And again, I couldn't do my job without you guys doing your job. So thank you. Appreciate that. And appreciate you taking a little time out of your afternoon or my morning, as the case may be, to be on the show. It's always good to talk to you and appreciate the light that you shine on the markets. And thank you for being on.
No, pleasure. Look forward to next time as well.
Yeah, absolutely. We'll definitely have you on again. And I hope you have safe travels over here to the United States and enjoy your time in New York.
Thank you. Looking forward to it.
All righty.
Always great analysis from our friends there at Metals Focus, and I hope you enjoyed that interview. Well, that will do it for this week. Be sure to check back next Friday for next weekly Market Wrap podcast. And remember to tune in to the Money Metals Midweek Memo, hosted by Mike Meharry and airing each Wednesday. To check out any of our audio programs, just visit moneymetals.com/podcasts, or find them on Spotify, Apple Podcasts, Google Podcasts, or wherever you listen to your favorite podcasts. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.